Good evening, everyone, and welcome. Nearly 250,000 jobs were added to the U.S. economy last month, and that clear sign of sustainable growth sent stocks sprinting higher today. Here are the numbers from the Labor Department. The economy added 248,000 jobs in September, up from 180,000 in August, a number that itself was revised higher today. The nation's unemployment rate fell to its lowest level since July of 2008, edging down 2 notches to 5.9%. On Wall Street, the Dow shot up 208 points, its first 200-plus point move to the upside since March, and enough to close back above 17,000. NASDAQ up 45, S&P 500 added 21, its best day in 7 months. Now, the jobs data pushed the U.S. dollar index to a fresh 4-year high, and that sent the price of gold, among other things, sharply lower, dipping below $1,200 an ounce for the first time this year. And crude oil closed below $90 a barrel for the first time in a year and a half. Wrapping up the 5 past sessions, though, the major stock market averages did end lower for the second week straight. All 3 indexes were down more than 0.5%. Hampton Pearson now takes a closer look behind those latest job numbers.
Much to the relief of both Wall Street and Main Street, job growth rebounded sharply in September from the disappointing 142,000 payroll number for August. The Labor Department says job gains for the last 3 months averaged 224,000 when you include upward revisions for July and August. And the headline unemployment rate is now 5.9%, the lowest since the summer of 2008.
The unemployment rate now below 6%. When you combine that with initial unemployment claims below 300,000 solidly, what it says is that the labor force is getting to that point where it's what we would call full employment. And that means that wages are going to start increasing more rapidly in the months and quarters ahead.
Wage growth, however, was flat in September and up just 2% over the last year. But paychecks got bigger because people work longer hours, and recent data shows some of that money is getting spent. The job gains were broad-based, with professional and business service sectors leading the way. And the Labor Department says the creation of more higher-paying jobs is now outpacing low-wage job growth.
This labour market is tightening. To me, this is all about the structural versus cyclical debate on labour force participation. And I think you score one for the structuralists here, because we're seeing the unemployment rate come down, we're seeing labour force come down, we saw the number of discouraged workers come down.
McLean, Virginia-based Cvent highlights a good-paying job success story. It's a high-tech worldwide event planning business that's in the process of hiring 500 new workers, a 30% increase in their workforce this year.
Our customers tend to sign multi-year contracts. We have commitments for many years. So we have high confidence, in our revenue for the future years.
Perfect.
Vivian Laurencato got hired right after graduating from Duke University last summer. Nationwide, job prospects for recent college graduates are improving.
I'm always challenged. It's high energy. It's a young tech company, so it's growing. So all these changes are being thrown at you. And it's a very fun company to be in. Everyone looks forward to coming to work.
The bottom line, according to the Labor Department, every major sector of the economy has seen a net increase in jobs in the last 12 months. For Nightly Business Report, I'm Hampton Pearson in Washington.
Let's get more now on today's jobs report from our 2 guests. We've got John Manley, he's Chief Equity Strategist at Wells Fargo Funds, and Mark Zandi, Chief Economist at Moody's Analytics. John, Mark, great to have you with us.
Thank you.
John, let me begin with you because I want to ask you about the stock market. Does this jobs number, this strong jobs number today, erase all the worries that we had this past week about weak growth in China, Hong Kong protests, problems with the economy in Europe? Does this really change things?
Those are 2 questions, actually. I don't think it fixes anything. I think those are still issues out there, but I think they become less important. I think the key factor here is the U.S. economy is growing. We never know what the future is going to bring. Sometimes we're just more uncertain about it. Those are usually buying opportunities. I think the fundamentals are still good.
Mark, let's turn to a question that has been bedeviling these generally positive job numbers all year long, and that is the question of the labor force participation rate. Without getting too wonky, it basically says the number of people who are taking part, either looking for a job or have a job. It's been coming down. But my guess is that it is partly coming down for reasons that are voluntary rather than coercive. In other words, there are a lot of retirees who are voluntarily stepping out of the job market. And given the pace of jobs growth, people who want a job can probably find something.
Well, I think you're right. I think the principal reason for the decline in participation is retirement. We've got a lot of baby boomers that are in their late 50s, early 60s. They're starting to retire, and that's bringing down participation. There's other structural forces. The disability insurance program and Social Security is having an impact. But I also think there is a cyclical element to it. If you look at the number of people who stepped out of the workforce but say they still want a job, they're not looking for various reasons. Maybe the pay is too low, there's not enough job opportunity. That's still very elevated compared to where it was prior to the recession. So I think those workers will come back in, and they will, at some point, lift labor force participation and labor force growth. Not a lot, a little bit, because you still have that retirement effect that's going to play out over many years. But there's still an element of a cyclical element to the decline in participation, and that should come back in as the labor market continues to improve.
Mark, I want to ask you a broader question about the economy. So we have the unemployment rate below 6%, 5.9%. We just heard Brian Westbury talking about full employment, oil prices coming down, U.S. dollar getting stronger. Connect the dots for us. For people at home listening to this, how's the economy doing? Are we really out of the woods? Is everything okay now?
We're certainly getting out of the woods, Susie. I think we've made a lot of progress, and the economy is, all the trend lines look really, really good. We still have a way to go. The unemployment rate is still elevated compared to where it should be. We still have people who stepped out of the workforce that need to come back in, and we still have a lot of part-timers out there that would rather work full-time. So there's still a lot of slack. By my calculation, if everything kind of sticks to script and all signs are good on that front, then by the end of 2016, so 2 years from now, that's when we'll be back to full employment. So we still have, everything looks good. We're on track, but we still have a way to go before we feel like we're completely out of the woods.
John Manley, let me turn back to you. Today's rally, was it significant in and of itself? Was it really just a relief rally or a reaction rally, or was it the end of something or the beginning of something?
Well, the market was off 4 or 5% at its worst, and it felt much worse than that. I think it is the beginning. I think it is the beginning of a pretty good earnings period that should be coming at us over the next 2 or 3 weeks. I think that puts the market on an upward pace over the very short term, and I still think we can go higher for a year or two before we have real problems.
So what happens next week, John? I've just put you on the spot for real near term. Are people going to come back after the weekend and be in the buying mood and to continue this, or are we going to just go the opposite way, have triple-digit losses again?
Well, there'll be triple-digit losses sometime, but I think over the short term, things get better. We're right on top of earnings season, maybe a few days off, but it's coming at us very quickly. So far, I see no reason to think the numbers won't be as they've been for the last 3, 4, 5 quarters, better than people expect, and a reason to buy, not sell stocks.
Okay, John, Mark, thank you so much. Have a great weekend. John Manley with Wells Fargo Funds, Mark Zandi at Moody's Analytics.